Hello everyone, welcome to the 187th episode of me learning how to trade in Forex. So in the last episode we were going through the videos basically in what are options. So we went through the call options, put options, options versus stocks, option strike price, and now we're on to the intrinsic and extrinsic value video. So yeah, got a little bit of summary to do. So a long call option always allows the owner to buy 100 shares of stock at a discount if it has intrinsic value at expiration. Short call option obligates the seller to provide 100 shares of stock to the call option owner if it has intrinsic value at expiration. So buying a call option is like betting on a stock price going up, and selling a call option is like betting against the stock price going up to a certain level. A long put option allows the owner to sell 100 shares of the stock at a higher price than the market if it has intrinsic value at the expiration. A short put option obligates the seller to take 100 shares of the stock from the put option owner if it has intrinsic value at expiration. So buying a put option is like betting on a stock price going down. Selling a put option is like betting against the stock price going down to a certain level. Your strike price gives you the flexibility on where to go long or short the stock instead of being forced to trade the market price. So you can go long or short stock at better prices using strikes that differ from the market price. The closer the strike price is to the stock price, the more extrinsic value it has due to the increased uncertainty there is that the strike price will have intrinsic value expiration. Intrinsic value is the difference between the strike price and the underlying share price. And extrinsic value is affected by other factors, changing the probability the option will expire in the money. So for example, how volatile the underlying market is and how much time there is until the contract expires. So, let's carry on where we left off at with intrinsic and extrinsic value then.
Now that you understand the basics of call and put options, we're going to hammer home the concepts of intrinsic and extrinsic value and how they relate to each option. As you've learned in the previous sections, intrinsic value refers to real value at expiration. Extrinsic value is extra value associated with a contract based on time left to expiration or the market's assumption of where the stock might go. This unknown factor is called implied volatility, which is just the implied potential move of a stock's price derived from actual option prices and how expensive or cheap they are relatively speaking. Ultimately, the more time to expiration, the more extrinsic value there will be in an option. The more fear there is that a stock will have a huge move soon, the more potential extrinsic value the option could have. When it comes down to it, option premium is really just made up of intrinsic and extrinsic value. If we have a call option that is below the stock price, it has real or intrinsic value because it offers the owner the right to buy 100 shares at a price below the stock price. If we have a put option that is above the stock price, it has real or intrinsic value because it offers the owner the right to sell 100 shares at a price above the stock price. If we have the total option premium and want to figure out what the extrinsic value is, we can just subtract the intrinsic value from the premium price. As long as an option has time to expiration, there is more than likely extrinsic value in the option, even if it doesn't have any real value yet. So what do we call options that don't have intrinsic value yet? What do we call options that are teetering on the stock price? How about options that have real value now, but we still have 30 days until expiration? We put context around these situations with a few terms: in the money, out of the money, and at the money. In the money, out of the money, and at the money are terms used to describe the option's contract strike price in comparison to the current price of the stock. In the money options have real intrinsic value at expiration, and out of the money options only have extrinsic value. At the money options are the strikes that are closest to the current stock price and are very close to having intrinsic value. It's important to note that in the money does not reflect profitability. It just means the option has intrinsic value. Out of the money options can be profitable prior to expiration even if they never go in the money. For example, if I sell an at the money put for $2 and the stock price goes up 10 points, my put is now very far out of the money and it is likely worth less than what I sold it for. If I buy that put back for less than $2, the difference would be profit. For a put option, the option is in the money if the strike price is above the stock price. If I have a long put at the strike price of 60 and the stock price is currently trading at 50, that option is in the money because the put allows me to sell 100 shares at $60 rather than $50. Since I know how to calculate intrinsic and extrinsic value, I can see how much extrinsic value is left in that option. If the option is trading for $12.50, I know that $2.50 is extrinsic value since the option is $10 in the money. If I have a short put at $40, that put option would be out of the money. With the stock at 50, the $40 put would not have intrinsic value at expiration. The put owner can sell shares at a higher price in the market than the put contract offers. Whatever the $40 strike put is trading for is purely extrinsic value as it is not in the money, but there is time until expiration and an assumption that the stock may move from the current price. As long as the stock is above $40 at expiration, I would keep the premium I collected up front as profit. For a call option, the option is in the money if the strike price is below the stock price. If I have a long call at the strike price of 35 and the stock is currently trading at $50 per share, that option is in the money because the call allows me to buy 100 shares at $35 rather than $50. If the option is trading for $15.50, I know that 50 cents is extrinsic value since the option is $15 in the money. If I have a short call at 60, the option would be out of the money. With the stock at $50, the 60 call would not have intrinsic value at expiration. The call owner can buy shares at a lower price in the market than the call contract offers. Whatever the $60 strike call is trading for is purely extrinsic value as it is not in the money, but there is time until expiration and an assumption that the stock may move from the current price. As long as the stock price is below $60 at expiration, I would keep the premium up front as profit. As you may see by now, the holder of a long option generally benefits when the option goes in the money, while the seller of an option generally benefits when the option stays out of the money. At Tasty Live, we like to take advantage of the extrinsic value that is offered in the option marketplace. The more extrinsic value we collect, the more we can reduce our cost basis on shares that we may own or are trying to own in the future. Therefore, when we're selling options, we're generally selling at the money or out of the money options. If we're creating a debit strategy with a long option, we try to reduce our extrinsic value as much as possible on the long option. This usually means buying the option in the money and selling an option against it to completely mitigate the extrinsic value decay we would have realized. We try to capitalize on extrinsic value when selling options and minimize extrinsic value when buying options, as extrinsic value will always be $0 at expiration. Let's review. The total premium of an option's price is simply extrinsic plus intrinsic value. If we want to calculate extrinsic value, we can subtract.
Right, okay, so summary.
The total premium of an option's price is simply extrinsic plus intrinsic value.
Yep, so total premium for a option equals extrinsic value plus intrinsic value.
If we want to calculate extrinsic value, we can subtract the intrinsic value, if any, from the option's price. When it comes to credit or short strategies, capturing extrinsic value is a good thing. When it comes to debit or long strategies, minimizing extrinsic value can be a good thing.
Right,
Value is a good thing. Value is a good price. When it comes to credit or short strategies,
when shorting options,
capturing extrinsic value is a good thing.
Capturing extrinsic value is good. When longing options.
When it comes to debit or long strategies,
When longing options.
minimizing extrinsic
Minimizing extrinsic
value can be a good thing. Check out the minimizing extrinsic value.
So minimizing extrinsic value is good. So this is maximizing. So try to maximize extrinsic value. So this is try to minimize extrinsic value. When shorting options, try to maximize extrinsic value. When going long options, try to minimize extrinsic value.
Value can be a good thing.
So in the money, out the money, at the money puts context around the strike price relative to the stock price. Being in the money is good for long options. Being out of the money is good for short options. Being in the money is good for long options. Being out of the money is good for short options. At the money options are just the closest option to the stock price, and they generally have the highest amount of extrinsic value due to the uncertainty of whether or not they'll be in the money or out the money at expiration. At the money options are the closest to the stock price. At the money options generally have the highest extrinsic value due to the uncertainty that of whether or not the option will be in the money or out of the money at expiration.
Check out the written piece in the section for more examples or for a refresher.
Cool. So they're nice little videos to watch, giving a nice visual representation of how everything works. It's much clearer than just reading paragraphs of text about it, so yeah, good. Trading options. So, trading options. 05/07/2024. Option trading strategies can be bullish if you think the underlying market will increase, bearish if you think it will fall, or neutral if you think it will stay roughly the same. They can offer significant leverage, as generally buying options is cheaper than buying 100 shares of stock, and it'll often mean your risk is capped at what you pay for the option, although depending on the strategy sometimes the potential losses are unlimited. So option trading strategies can be bullish, bearish, or neutral. Remember, options contracts grant the holder the right but not the obligation to buy or sell an asset at the predetermined strike price before the specified expiration date. These contracts derive their value from two components: intrinsic value, which represents the real value of the option at expiration based on the underlying asset's price relative to the strike price, and extrinsic value, which accounts for the time remaining until expiration and the implied volatility of the asset. Option contracts grant the holder the rights but not the obligation to buy or sell an asset at a predetermined strike price, before a specified expiration date. These contracts derive their value from two components. These options contracts derive their value from two components: extrinsic value and intrinsic value. Intrinsic value represents the real value of the option expiration, the real value of the option at expiration based on the underlying asset's price relative to the strike price. Based on the underlying assets price relative to the strike price. An extrinsic value, so extrinsic value represents the time, accounts for the time remaining, so extrinsic value accounts for the time remaining until the expiration, and the implied volatility of the asset. To master the intricacies of options trading, you need to build a thorough understanding of contract parameters, e.g. strike prices, expiration dates, as well as the mechanics of exercising or being assigned options contracts. So to master the intricacy, you need to build a thorough understanding of contract parameters, e.g. strike prices, expiration dates, as well as the mechanics of exercising or being assigned options contracts. You should also get to grips with the Greeks, a set of measures that track how sensitive an option is to the factors that impact its value. With a solid grasp of these fundamentals, traders can construct strategies that align with their risk tolerance, market outlook, and investment objectives, harnessing the versatility of options to potentially enhance their portfolio performance. To be good at options trading, build a thorough understanding of contract parameters such as strike prices and expiration dates, mechanics of exercising or being assigned options contracts, the mechanics of exercising or being assigned options contracts. You should also get to grips with the Greeks. Learn the Greeks. Set of measures that track how sensitive an option is to the factors that impact its value. So the Greeks are the delta, vega, and theta. With a solid grasp of these fundamentals, traders can construct strategies that align with their risk tolerance, market outlook, and investment objectives, harnessing the versatility of options to potentially enhance their portfolio performance. Learn more by watching these guides to key options trading concepts. Some more videos, buying versus selling options.
Now that you know the basics of call and put options, we'll dig a little deeper and look at the pros and cons of buying versus selling options. There are a few popular reasons people tend to trade options. Speculation is one of those reasons and is usually associated with buying options. Because options have expiration dates, I have the ability to obtain the exposure of 100 shares of stock for a fraction of the cost of the actual shares. If I have a strong directional assumption, owning a call option would give me way more leverage than owning shares, and my potential return on capital could be much higher for that reason. I can also speculate on a stock selling off by purchasing a put. The same concept applies, except now I have the exposure of 100 shares of short stock when I purchase a put. Because this contract expires, I put up much less capital than shorting 100 shares of stock, and unlike shorting shares, my max loss is capped at the debit paid for the put contract. Others may be looking to protect their shares of stock by purchasing options at different strike prices. I can fully insure or protect 100 shares of long stock by purchasing a put contract. If the stock drops below the put strike, I'm fully covered, as the put contract allows me to sell 100 shares of stock at that strike price. If I'm short 100 shares of stock, I can purchase a call option to protect my shares against any upside movement. Protecting long shares of stock by purchasing a put is a popular strategy in the industry, which is why you typically see puts trading at a higher price than equidistant calls in equities. The more people buying the puts, the higher their price will be. This imbalance in price when you compare puts and calls is known as volatility skew, which you'll learn more about later. Investors can also sell options, and many do so to hedge or reduce the cost basis of their positions. If I own 100 shares of stock, I can underhedge my position by selling a call against the shares. This isn't a perfect hedge like owning a put because it doesn't completely protect my shares to the downside. This does allow me to collect premium though, which reduces the cost basis of my shares and also allows me to benefit from any increase in the stock price up to the strike of my short call. The same thing can be done with short shares and a short put, which allows me to improve the cost basis of my short shares with the sale of a put, and I can still profit from any downside movement down to the put strike. These strategies are known as covered calls and covered puts, and you'll learn more about them later in the course. Trading the probability of an option expiring worthless is the tasty live wheelhouse and closest comparison to an insurance agency or casino. We're taking small risks over a large number of occurrences, taking advantage of generally overpriced options, and betting against a stock having huge moves. This approach is where strategies get really flexible, as I can literally create ranges of profitability rather than static direction in stock trading. When it comes to a put contract, the buyer benefits when the stock goes down. In order for the buyer to see a profit on the put at expiration, the strike must have more intrinsic value than the extrinsic value paid for the right to own the contract. This is why we prefer to sell put options. Our research shows that more often than not, extrinsic value is too expensive relative to the move the stock actually makes. When selling a put, I can profit if the stock stays the same or goes up. In these cases, the put would be worthless at expiration and I'd keep the initial credit received as profit. The stock can even go down a little bit as long as it doesn't go below my put strike. For call contracts, the buyer benefits when the stock goes up. In order for the buyer to see a profit on the call at expiration, the strike must have more intrinsic value than the extrinsic value paid for the right to own the contract. This is also why we prefer to sell call options. Our research shows that more often than not, extrinsic value is too expensive relative to the move the stock actually makes. When selling a call, I can profit if the stock stays the same or goes down. In these cases, the call would be worthless at expiration and I'd keep the initial credit received as profit. The stock can even go up a little bit as long as it doesn't go above my strike. In the end, option sellers have a lot more flexibility than those that buy them.
Option sellers have more flexibility than those that buy them. So
sellers take on undefined risk but have a higher probability of success compared to option buyers. Option sellers are like insurance companies, where option buyers are like those that are insured. Feel free to watch this video again if
option sellers can profit in multiple ways at expiration. Option buyers need the strike to be in the money by more than the extrinsic value they paid to be profitable at expiration. Buying an option is like buying an insurance contract. Selling an option is like being the insurance broker. Option buyers need the strike price to be in the money by more than the extrinsic value they paid to be profitable. They paid to be profitable at expiration. Buying options is like buying an insurance contract. Buying an option is like buying an insurance contract. Selling an option is like being the insurance broker. Cool?
if you're still fuzzy, and read the content below for more information. Don't forget to take the quiz, as we are now at the end of Options Basics.
Right, okay, so options expiration then.
Okay, so we know that call and put options give us the right to buy or sell shares, but when does this actually happen? If an option is held through expiration and it has intrinsic value, the brokerage will exercise the option and it will turn into 100 long or short shares of stock. A long call will turn into 100 shares of stock, and a long put will turn into 100 short shares of stock if these options have intrinsic value and are held through expiration. A short put will turn into 100 shares of stock, and a short call will turn into 100 shares of short stock. The transactions above assume that I don't already own shares. If I do own shares, I may end up with no position at all. For example, if I'm long 100 shares of stock and I own a put, or I'm short a call, and the option expires with intrinsic value, both of these contracts will turn into 100 short shares of stock, but since I'm already long 100 shares, I'll be left with no position. I can't be long and short shares at the same time, and the brokerage recognizes this. If I'm short 100 shares of stock and I own a call or I'm short a put, and they expire with intrinsic value, I will be left with no position. The short put and long call both turn into 100 shares of long stock, and since I'm already short 100 shares, the position would disappear. The most important thing to remember is that if I have an option that's in the money or has intrinsic value, if it's held through expiration, it will turn into long or short shares of stock. If an option is out of the money or has no intrinsic value, it will expire worthless and nothing will happen. There are products that have option markets but not stock markets, and those typically expire to cash. These are known as cash-settled indices. Because there are different expiration dates with options, there are different classifications of expirations. This sounds complicated, but it's pretty simple when you break it down. Regular expirations are monthly expirations, which are on the third Friday of every month. This is where most investors trade, which makes for a good trading environment. The more activity there is, the easier it is to get in and out at a fair price. This is known as liquidity, and something we'll dig into later in the course. There are also quarterly expirations, weekly expirations, which are typically every Friday, and leaps, which are just very long-term option contracts. We follow the herd when it comes to activity, so we're typically trading regular monthly contracts with most other investors. Different expiration cycles will offer different extrinsic value premiums, and it's as simple as this. The more time there is to expiration, the more extrinsic premium value there will be. Just like an insurance contract, if I'm only insuring my car for a year, my total premium will be much less than if I were to insure it for 5 years. As an option owner, I'm paying for time to be correct in my assumption. As an option seller, I'm being paid for the risk that I'm taking. For example, if I own a 50 strike call and XYZ stock is at 55, my option has $5 of intrinsic value because it gives me the right to buy shares at 50 rather than 55. This option would be worth $5 at expiration, but it might be trading for $6.50 right now. That extra $1.50 in premium is extrinsic value, and that is the extra value associated with the contract based on the time left to expiration and how much implied volatility or potential movement the market is pricing into the option. When we talk about reducing the cost basis of shares that we may own, the more premium we collect when selling options, the more we reduce our cost basis. At the same time, we typically don't want to sell leaps against our shares that we own, as extrinsic value decay will be minimal day to day. We stick around the 45-day till expiration window so that we speed up our extrinsic value decay and collect a decent amount of premium for the risk that we're taking. We tend to trade the monthly cycles unless there's better liquidity in a different cycle. When companies announce their earnings for the quarter, we may trade in the weekly cycle that contains the announcement, as many people will be hedging their positions with options in that cycle. Really, it all comes down to liquidity, or the ease and fairness of getting in and out of positions, and a target date of 45 days till expiration for most strategies, to optimize our extrinsic value decay, otherwise known as theta decay. Let's review. Different expirations can be overwhelming, but it really offers us more flexibility as traders. We can trade in many different expiration cycles rather than just a few per year.
So, more expirations equals more flexibility.
Monthly expirations are typically the most liquid, as many traders focus on those expirations when trading options.
Monthly expirations are typically the most liquid.
If an option is in the money or has intrinsic value, it will turn into long or short shares of stock if held through expiration. Long calls and short.
So options that have intrinsic value will turn into shares of stock if held through expiration. Turn to shares of stock if held through expiration.
Puts turn into 100 long shares, and long puts and short calls turn into 100 short shares. Check out the written content below and prepare yourself to learn long or short shares of stock if held through expiration. Long calls and short puts turn
Long calls and short puts
into 100 long shares.
Long calls and short puts turn into 100 shares, 100 long shares.
And long puts and short calls. Long calls and short puts turn into 100 long shares.
And then short calls and long puts turn into 100 short shares.
Long calls and short puts turn into 100 long shares, and long puts and short calls turn into 100 short shares.
Yep.
Check out the written content below and prepare yourself to learn about strike prices in the next section.
Nice. So, I don't think these are these videos are put in order because he said learn about strike price in the next section. Isn't that this one, option strike price? But okay, it is what it is.
Okay, and long puts and short calls turn into 100 short shares.
Now we're on to implied volatility intro. So, let's get started then.
Implied volatility, or IV, refers to the expected potential movement of a stock's price.
Implied volatility.
In previous sections, we talked about implied volatility, or IV, refers to the expected potential movement
Is the expected potential movement
of a stock's price.
of a stock's price. Whoops. Stop.
Implied volatility, or IV, refers to the expected potential movement of a stock's price.
Yep.
In previous sections, we talked about a market opinion of where a stock might go. Implied volatility is exactly that. Implied volatility is imperfect information that is derived from option prices in the underlying market. When people are buying options, which drives up their prices, implied volatility increases. When they're selling options, which drives down prices, implied volatility decreases. IV is presented on an annual one standard deviation basis. This sounds complicated, but all this means is that based on the option prices, the stock has a 68.2% chance of landing within the range IV is presenting. IV is known as a fear gauge because when IV increases, that generally indicates uncertainty in the market, where investors are buying options to speculate or hedge their long or short stock positions. If we see that a stock has a high IV, that usually means option prices are trading at a higher premium than they normally would, and we should not be surprised by big moves in the stock price. Conversely, if we see a stock that has a low IV, that usually means option prices are trading at a lower premium than they normally would, and we would not be surprised by a lack of movement. An IV of 20% is pretty mediocre, even though the option prices are projecting a 40-point window over the course of a year. If XYZ stock is trading at $100 per share and has an implied volatility of 20%, the annual one standard deviation range is between $80 and $120. In other words, over the course of a year, the stock price has a 68.2% probability of being between $80 and $120. A standard deviation is a popular statistical metric used to put context around stock price movements and accounts for most of the occurrences, so IV is presented on a one standard deviation basis. The fact that this accounts for most, but not all occurrences, means that there is still a realm for error, which is why this is imperfect information. Regardless, it is still pretty darn accurate and helps us put expectations around potential stock price movements and whether options are trading at a relatively high or low premium. If you compare the options in this 20% IV market to a 40% IV market, they would be trading at a lower premium than the 40% IV environment, which would indicate a stock price movement between $60 and $140 in 1 year's time. Because there is even more uncertainty in this high IV environment, option prices must be more expensive. The higher the IV is, the more fear there is in the market that the underlying may have a huge move soon. Implied volatility is dynamic and changes frequently as option prices fluctuate. High IV stocks don't always move, and low IV stocks can have huge moves, so realize that IV is not guaranteed. IV simply puts context around what the market is expecting from the stock price within a certain time frame. High implied volatility is what we look for as option sellers. When IV is high, it indicates that option prices are high relative to the value of the stock. If we look at XYZ in two different scenarios, we can see how premium levels affect IV. In the previous examples, we compared a 20% IV to a 40% IV to show you the expected move for an underlying price. Looking at selling a put at $95, which obligates us to be put 100 shares of stock, we can see that the 40% IV environment offers double the credit compared to the 20% IV environment. Even though our expectation of potential movement is higher, we get paid for this implied volatility in extrinsic value premium. If my goal is to become long 100 shares of stock by selling a put, my break-even price is actually better in the high IV environment at 88 compared to 91.50 in the low IV environment, as the increase in premium collected lowers my risk to the downside. Additionally, my potential max profit doubles in the 40% IV environment compared to the 20% IV. The higher the IV is, the more premium I can get for the options that are close to the stock price. Let's look at a different scenario. Maybe my lucky number is 350 and I just want to collect $3.50 from a trade. When you compare the two environments and understand that the 40% IV has a much higher premium at the money, maybe I can slide my strike further out of the money to collect that same $3.50. Now my strike is at 90, my break even is at 86.50, and I have a lot more space to be successful. As you can see, there's plenty of flexibility in a high IV environment. Also, because IV is dynamic, we could see that 40% IV drop down to 20%, which would tell me that option prices have dropped dramatically. The benefit here is that I've already locked in the 90 strike put, and if we get a contraction in implied volatility, that could reduce my strike's price pretty dramatically. I might be able to get out of the trade for a nice profit in a few days if this happens, which opens up a whole new world of opportunity. We don't always have to wait for stocks to move in our favor or for time to pass when trading implied volatility. In any case, we'd much rather sell premium at 40% IV and see it drop to 20% than sell at 20% and see it rise to 40%, which is why we sell options in high implied volatility environments. History shows that when we see a big spike in IV, we tend to see a contraction at some point in the future, which benefits the seller. Another reason we prefer to sell premium rather than buy it is because our research shows that option prices tend to be overstated. We backtested a large number of occurrences and found that more often than not, implied volatility overstated realized volatility. What does this mean exactly? Essentially, options were too expensive relative to the actual moves underlyings made, and this benefited the seller in the long run. Many opponents of selling premium say that trading options is a zero-sum game, meaning we should break even over the long run. That assumes the option pricing model is perfect, or in other words, implied volatility is equal to realized volatility, which is not typically the case based on our research. Let's review. Implied volatility is simply the expected move of an underlying price over the course of a year. It is presented on a one standard deviation.
Option prices drive implied volatility, not the other way around. Right, okay, so option prices drive implied volatility. Implied volatility doesn't drive option prices.
Basis, which accounts for 68.2%. Implied volatility is simply the expected move of an underlying price over the course of a year. It is presented on a one standard deviation basis.
Presented in a one standard deviation basis,
which accounts for 68.2% of occurrences.
which is 68.2% of, so these are all occurrences.
For 68.2% of occurrences.
Of occurrences, okay, of occurrences.
Because this doesn't account for all occurrences, it's imperfect information, and we should account for this in our decision-making process.
Implied volatility is not 100%, therefore take this into account when making decisions.
Volatility tends to be pretty predictable at the same time process. At the same time, implied volatility tends to be pretty predictable as it often rises from its lows and falls from its highs.
Implied volatility rises from lows and falls from highs.
Implied volatility is derived from option prices, and if we compare two underlyings with the same stock price and see different premiums in the same expiration cycle, that must mean they have different implied volatility percentages as well. This was a lot of information, so feel free to check compared.
So, implied volatility is not guaranteed, but is a good gauge of expected movement based on the option market. Implied volatility is presented as an annual potential move on one standard deviation basis. High implied volatility indicates rich option prices relative to the stock price. Low implied volatility indicates cheap option prices relative to the stock price. High implied volatility indicates rich option prices relative to the stock price. Low implied volatility indicates cheap option prices relative to the stock price.
Two underlyings with the same stock price and see different premiums in the same expiration cycle, that must mean they have different implied volatility percentages as well.
True.
This was a lot of information, so feel free to check out more written content about implied volatility below. With the same stock process. At the same time, implied volatility tends to be pretty predictable as it often rises from its lows and falls from its highs. Implied volatility is derived from option prices, and if we compare two underlyings with the same stock price.
So if the same two underlying stock price was compared
and see different premiums in the same expiration cycle.
And there's two different premiums with the same expiration.
That must mean they have
different
cycle. We compare two underlyings with the same stock price and see different premiums in the same expiration cycle.
Yep. If the same two underlying stock price was compared and there's two different premiums with the same expiration cycle,
that must mean they have different implied volatility percentages.
It means they have different implied volatility percentages
as well. This was a lot of information, so feel free to check out more written content about implied.
So if the same two underlying stock price was compared and there's two different premiums with the same expiration cycle, it means they have different implied volatility percentages as well. Yep. Okay, so I am going to leave this episode here. In the next video, we're going to carry on with the videos, and there's loads, it looks like, with expected move explained. So thank you all for watching, and I shall see you all in the next video. Actually, you know what? Note to self, I'm going to start making some notes in these videos because I think some of them will start saying, well, not start saying, but some of them have some important information which could be noted down, so, and not just from the review section. So yeah, so make notes in the videos. Cool. Thank you for watching. See you next time. Laters.